Welcome back. What have we done so far? First, we looked at capital structure in a perfect world, and capital structure did not matter. Second, we looked at capital structure in an imperfect world, and we learned that corporate income taxes push the firm towards debt, and personal income taxes push the capital structure towards equity. The presence of different types of firms and investors results in a sorting of clienteles that exists to reduce the aggregate tax received by Uncle Sam. And third, we also discussed how owners internalize any stupid corporate charter and capital structures they pursue. Now we take the next step. You also know that income taxes aren't the only capital market imperfection. We had not just one, but four perfect capital markets assumptions. This chapter is about the stuff other than taxes. There are at least two other imperfections that investors, companies, suppliers, customers, your own talent, employees have to worry about. The first is transaction costs. Transaction costs can be quite high, especially in financial distress. I will explain this in a few moments. The second is information differences. That one is devious too. When managers know things that investors don't, it can become quite tricky. I will explain this soon. Now, for startup companies, the final assumption, competitive markets, can also be important in itself. For large companies, there are typically many potential competitive capital market providers, so this one matters less. Let's get started. Bankruptcy in the United States is actually described in the US constitutions. It is what enables the federal bankruptcy code. There are two important chapters here. Chapter 7, bankruptcy, means liquidation of the firm. The firm is basically dismembered and its parts are sold off. Chapter 11 is reorganization. That means the firm continues to run, usually overseen by a federal bankruptcy court, with the idea that eventually it will re-emerge from bankruptcy and be a running concern again. That doesn't always work, in which case sometimes Chapter 11 gets converted into Chapter 7. Now, when you enter bankruptcy, a federal bankruptcy court appoints a bankruptcy administrator and oversees the process. That is a very lucrative racket for courts and lawyers. It's also reinforced by best practice claims. Others do it that badly too. It's not easy for companies upfront, ex ante, to contract around this. So, for example, you can't agree with your providers of goods or your customers that you're going to go into arbitration. When bankruptcy hits, the US takes over. Now, we've already worked with bankruptcies in a sense. We worked with redistribution. So when we made the nice little charts where you had both debt and equity and we computed how much money you would get, we had a company go bankrupt. But under those circumstances, all that happened was that the money, the residual cash flows, would go to the creditors instead of the equity. End of story. There was no overall loss of value. That is also why the value of the firm didn't change. Any capital structure was as good as any other. We now work with deadweight financial distress costs. What that does is that the sum total of the firm value declines when the firm goes bankrupt, or perhaps even when it just approaches financial distress and bankruptcy. For example, all of a sudden you get close to bankruptcies and your managers may have to spend a lot of their time with lawyers instead of selling product. There's a real cost to this. So if you get close to this, the overall value of the firm will be less. Both are internalized in security prices, but the costs have different implications. The redistributive bankruptcy cost does not matter to capital structure. That was the perfect capital markets. It was just who would get the claims, it didn't matter. The deadweight costs, on the other hand, do matter to the optimal capital structure. They generally favor equity over debt because the more debt you have, the more likely you are going to get into financial distress. And financial distress, in turn, is likely to cause extra inefficiencies. So, over the envelope, let's try and calculate the costs that large companies endure in financial distress or bankruptcy. So let's imagine a large, publicly traded, healthy S&P 500 firm with assets of about $100 billion. There's a 5% probability of bankruptcy. That is empirically a very high number. It's probably more like 1 to 2 usually. But in the financial crisis of 2008, 2009, there could have been about 5%. So it's really a high estimate. If and when a firm goes bankrupt, the firm isn't going to be worth $100 billion anymore. It means that the value will have gone down to something much less. The firm has gotten into trouble. So let's say the firm has gotten to be worth about $20 billion. Now, empirically, during bankruptcy, deadweight costs are about 2% of whatever the firm assets will be at the time the firm goes bankrupt for these very large corporations. Multiply all the three numbers that we've got, 20 billion, which it will be worth, 5%, which is the probability that you run into trouble, and 2% that you have to pay to the lawyers, and you end up with about $20 million. Now, that pays for a lot of lawyers and a lot of expert witnesses in bankruptcy, but it's really only 0.02% of the $100 billion firm value today. So if you think about this as a force that's going to pull capital structure towards equity today, when the times are still good, in order to avoid future potential bankruptcy costs, that force is going to be very weak. Now, small companies, the picture looks very different. Small firms go bankrupt far more often. Their direct deadweight bankruptcy costs can often amount to 100% for small firms. So say you have a small firm with assets between $5 and $10 million, chances are the lawyers will take it all. They leave nothing for unsecured creditors and shareholders. It's similar to US class action lawsuits, where it's really only the lawyers making one another rich. The people that were actually hurt by whatever the companies did get almost nothing. In my opinion, the rule of law in the United States has broken down for small and mid-sized firms. You cannot rely on courts and lawyers to resolve disputes in a way that is efficient and allows the firm to continue operating. There are also indirect costs to financial distress and bankruptcy, and they come in many forms. I'm going to show you what I mean. What happens if you have sold an item to a company that goes bankrupt and the company has not yet paid your bill?
Please pause this video now, answer the question on a piece of paper, and then continue.
You become an ordinary creditor. In Chapter 11, it may take years, if ever, to get the money you are owed. The bankrupt companies gets to keep and even sell what you deliver to it, but they don't have to pay you. If, unbeknownst to you, the vendor of a product that you bought goes bankrupt 3 months later, what happens to your product warranty and, say, any necessary product maintenance?
Please pause this video now, answer the question on a piece of paper, and then continue.
It's worthless. There was a company called Adam Aircraft which produced a really nice aircraft called A500. Okay, it had some problems. It turns out when Adam Aircraft filed for bankruptcy, you couldn't fly Adam Aircraft A500s anymore. Not so much because there were no spare parts to be had, but because the company wasn't around anymore to certify to the FAA that it's complied with all the latest regulations. So your aircraft that you would have bought for $1 million all of a sudden was completely worthless. Isn't it great for the company, not the customer, that it no longer has to honor warranties or frequent flyer miles or any of its other obligations? Of course, it's great ex post to allow you to shirk on your promised warranties. But the problem is ex ante, it could make you a less viable airplane ticket sellers if your potential customers are not ignorant, stupid, and are so greedy that they can't see warning signs. Bankrupt airlines in the past, incidentally, often kept honoring their frequent flyer miles, hoping to retain more customer loyalty. They didn't have to. They could have just canceled and voided all of them. What happens to your paid airplane return ticket if you are mid-trip in Europe and the airline goes bankrupt?
Please pause this video now, answer the question on a piece of paper, and then continue.
You're stranded. Your return ticket may be worthless. Good luck finding an affordable one-way replacement airfare on short notice in competition with thousands of other stranded passengers. What happens to a car you purchased 3 months ago from the Toyota, Honda, or General Motors dealer if the car dealer goes bankrupt?
Please pause this video now, answer the question on a piece of paper, and then continue.
It turns out the bankruptcy trustee can demand that you return the car, but not return your money. That gives you only a general claim on the bankrupt assets, and typically these will end up worthless. The law justifies this as undoing what is called fraudulent conveyance. It's happened less with cars. However, it's happened to a friend of mine who purchased an airplane from an airplane dealer who later on, months later, went bankrupt. The bankruptcy trustee came to my friend and said, "Give me back the airplane." To which my friend said, "Sure, give me back my money." No, he didn't get the money. He lost his airplane. And we have the judge on record saying that, "I'm sorry, bankruptcy trustee, this is a completely shitty thing to do, but I cannot undo it. This is what the law says." Should you, as a customer, invest corporate resources into a computer vendor's proprietary, much better product if you fear the vendor may go bankrupt?
Please pause this video now, answer the question on a piece of paper, and then continue.
Again, in this case, if the vendor goes bankrupt, you may have to ditch all your millions of dollars of software development and training expenses and start over. Tech bankruptcies are not uncommon. So, it depends on how much customer expenses like training and specific investment a product requires. For example, compatible vanilla PCs, you may not need to worry. There was a time when it wasn't clear whether Apple was going to survive. And when that was the case, many companies were very wary to buy a Mac because they would then be stuck with a PC for which there's no parts, for which they had to train their employees, and for which there was no future generations anymore. Now, part of why open source is so successful is because if the one company that runs it goes out of business, somebody else can take it over. So that's a little bit of insurance against companies going bankrupt. What happens if your tenant has signed a 10-year lease and then goes bankrupt?
Please pause this video now, answer the question on a piece of paper, and then continue.
I think by now you've understood the pattern. The tenant can usually break your lease without penalty, and you're stuck. Your 10-year lease document You can use that as toilet wipe. It has no other significance anymore. Why and when would a company be concerned about going bankrupt in the distant future? Isn't it great that the company will no longer owe their obligations then?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, it's bad today because it can influence your supplier and customer purchasing behavior today. There are many examples where companies only accept cash. So, for example, Lufthansa Servicegesellschaft, which provides food service to airplanes, insists on upfront payment even from large airplane companies. You better have more money now than you would otherwise if you're running an airline, because nobody trusts you not to go bankrupt. Same thing with aircraft fuel companies. They don't give you a lot of credit. So even aircraft are nowadays no longer sold to airlines, much less on credit, but only leased to them. See, the banks and nobody would be happy to lend money to airlines. When the airline goes bankrupt, they can break any contract except for the lease. In a lease, legally, the lessor still owes the airplane. So that changes the situation. That's why most airlines now lease their airplanes. It's the only way that somebody will give them airplanes. They can no longer buy it on credit. If direct and indirect costs of financial distress are high, because your suppliers, your customers, your most talented employees, partners are afraid of you going bankrupt, and if there are no countervailing forces, what security would this favor? Debt or equity? What would be the optimal capital structure?
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, the probability of financial distress increases with debt. Therefore, equity would be better than debt. It need not be actual bankruptcy. It is the possibility of bankruptcy that can be enough to hurt you. So, if you finance the company with more equity today, it would make your operating today, even before distress, more profitable. Now, change of topic. We'll talk about risk shifting incentives in financial distress. Now, imagine you are a fund trader or trader on Wall Street. It's September now. You realize that you're now underwater for the year. So you're trading about $10 million in the beginning of the year, and you look and your balance now says $9 million. You lost $1 million. What kinds of bets would you take now? Would you prefer taking more risky bets or less risky bets?
Please pause this video now, answer the question on a piece of paper, and then continue.
More risky bets. You will probably be fired anyway if you conclude the year underwater. For sure, your bonus would be zero anyway. There have been many situations in which there were rogue traders inside companies who started with small losses and then tried to evade the risk controls of the company. Sometimes they outsmarted the risk system. The risk system didn't have it in there that this particular security was far more risky than the risk system thought. And they use this to ramp up their risks when they are a little bit underwater. Would you potentially ever take on a negative NPV bet if you were such a trader?
Please pause this video now, answer the question on a piece of paper, and then continue.
Yes, if it is risky enough. What you would really want almost under those circumstances, you want to bet $9 million. If you win, it's great. If you lose, you're going to get fired, but you were about to get fired anyway. And if you win, all of a sudden, you have $8 million profit. You're going to get bonus and promotion. In what kinds of firms would you expect this kind of risk-shifting behavior to matter most?
Please pause this video now, answer the question on a piece of paper, and then continue.
Firms where it's easy to ramp up the risk and difficult to ramp up the reward. So on an assembly line, it's very hard to make risky decisions. So you don't have to worry about risk shifting where the employees all of a sudden take on far more risk. On the other hand, for financial traders, it's very easy to take on more risk, especially if the risk systems of the company aren't perfect. Ex post, after the firm has taken on a lot of debt, will equity, and remember, management usually works on behalf of equity, will equity managers prefer taking on more risky bets?
Please pause this video now, answer the question on a piece of paper, and then continue.
Indeed, it will. The firm may even like these rogue traders. So imagine your manager acts as a representative of equity, and you have $99 million in debt and $1 million in equity. Would you like to take a project that has minus $50 million or plus $25 million? This is a real negative NPV project if the two are equally likely. Would you like to take this project? Well, if you think about this for a moment, if you win, you are plus 24 million for your equity holders. If you lose, they get zero. But if you don't get the bet, if you don't take the bet, they get zero also. So you would definitely want to take this bet. As a result, here you have a situation where getting close to financial distress makes you do the equivalent of burning money. You are losing money. You are going to take $1 million or more and just burn it up because you like this risk so much. And if you have a more equity-heavy capital structure, it's less likely to get into this situation. You would never take this bet if the capital structure had been $100 million equity and no debt. Let me change topic again. Let's think about asset maintenance. Imagine your mortgage is modestly underwater. For example, you may have bought a house for $1 million with an $800,000 mortgage, and its value has just fallen in a housing crash to $780,000. Now, you've just learned that your roof has a water leak, and to replace your roof will cost $50,000 to repair. If you don't repair it, it will rain into the house, and it may cause another $100,000 of damage, and everything may rot in there. Would you replace your roof?
Please pause this video now, answer the question on a piece of paper, and then continue.
Absolutely not. You would have to pay the entire amount of the roof change, $50,000, and it would be the bank that would reap most of the value. Incidentally, a more extreme version of this is negative maintenance. That happened very often during the financial crisis, where there was a lot of mortgages very far underwater, and the people that owned it at that point had no chance of getting their money back. Before they left the house, they ripped out the appliances and sold them. They ripped out the copper pipes and sold them, and then gave the house back to the banks. These are self-fulfilling prophecies. Economists call them equilibria. As firms fall in value or take more debt, financial distress becomes more likely. This in turn increases their misbehavior incentives. So they may take some mildly negative NPV projects, which can put them quickly even more underwater. And as they get more and more underwater, the bad incentives quickly become even worse. In this case, they're going to take really negative NPV projects, which can put them quickly even far more underwater just because of that tiny probability of hitting the jackpot. Economists call self-fulfilling prophecies equilibria. It's sort of like the plot of a bad movie. So, optimal capital structure with distress costs. If financial distress costs are large, companies should be financed more by equity than by debt. It's because they are less likely to get into financial distress. The effect is usually convex, accelerating. For modest debt amounts far away from financial distress, the expected distress costs are often very small. But as the company falls in value, the distress probability and distress costs often rise rapidly as you get very close to the bankruptcy threshold. What does it mean to have a high debt ratio where you run into problems of financial distress? Typically, we think about debt ratios of 80 to 90%. And interestingly enough, this is standard for financial firms. JP Morgan, Goldman Sachs, all of these firms are run on a very thin equity cushion and have greater than 90% liabilities, debt. So financial firms live almost constantly near financial distress. The economy overall goes down, a good number of their loans go down. They can very easily get underwater. Perversely, as you just learned, their equity shareholders, traders, and management love more risk when they get nearer to financial distress. So they would really like to gamble with the money. But there's another perverse problem here. The government looks at this and it thinks, if JP Morgan and Goldman Sachs go bankrupt, our economy is going to experience the biggest depression that it has ever had. Far more so than the Great Depression from the 1930s. We can no longer afford to have JP Morgan Chase, Goldman Sachs, or any other number, maybe 10, 20 companies, banks, go bankrupt. We have to bail out the company if it gets close to financial distress. Now, because financial distress, bankruptcy is in the US Constitution, the creditors can always say, no, we don't accept it. Let's do this over the next 2 to 3 years in bankruptcy court. Well, I'm afraid if you're the US government, you cannot afford 2 to 3 years of a depression. And in fact, you don't know when it will get resolved. There's all sorts of problems that come up. So the only way that you can avert a depression is by bailing out not only the equity, but also the creditors. The creditors of the banks know this. This makes it easy for the banks, in turn, to obtain cheap credit financing. It's the taxpayers that are on the hook if they fail. This explains almost all of the financial crisis of 2008 and 2009. There are terrible incentives in our financial systems that induce banks to gamble like crazy, and we cannot allow them to go bankrupt as a government. Now, the opposite is a company that has a low debt ratio, say below 50%. Under those circumstances, typically, financial distress costs tend to be unimportant. They become important only if the company enters into economic distress first, like all of a sudden its products don't sell anymore. Under those circumstances, couldn't you create value by just buy the entire company, all debt, all equity, restructure it to take away the debt that creates all these financial distress costs, sort of in line with the Modigliani-Miller intuition? The problem is there's something called hold-up costs. So if you are a creditor and I were to make an offer to buy you because I would then restructure the company, you would say, no, I insist on you buying my debt at par value, even though it's no longer worth par value, because otherwise you cannot avoid bankruptcy costs. So the only way that the acquirer could manage to take over the company and execute M&M under those conditions would be to suffer these hold-up costs, and that makes it financially not viable. Here is another subject that sometimes comes up in financial distress. There was a company called Research in Motion, which once manufactured the dominant mobile device, were called BlackBerries. In 2007, the iPhone made BlackBerries nearly instantly obsolete. Ask the CEO of Research in Motion, what should you have done in 2008, 2009? Should you have spent more money on more research and development? They tried to come up with something called playbooks to compete with the iPhone.
Please pause this video now, answer the question on a piece of paper, and then continue.
Well, by that time, corporate customers had already stopped investing in the necessary BlackBerry support structure. What you really should have done as Research in Motion CEO, you should have sold your firm ASAP for all its patents and all its customer base to whoever the highest bidder was. In the real world, as a manager rather than an owner, you would have suffered from something called moral hazard. You would have liked to continue on with the R&D and gambled the money of the shareholders in order to see whether you can resurrect BlackBerry for it to come back. There's a beautiful old movie called Other People's Money with Gregory Peck and Larry the Liquidator. Towards the end of the movie, the two have wonderful speeches that illustrate the problem in the context of copper manufacturers. It's really worth watching. It's also a funny movie. Now, what capital structure should you choose if this bad continuation is a serious concern?
Please pause this video now, answer the question on a piece of paper, and then continue.
Wake up. This time, it's not equity. See, if you have a lot of debt, that debt can force management to liquidate before they're all going to piss away all their money in useless pursuits. And of course, I shouldn't have used the term, but it's true. I omitted a few forces that are related to the firm's competitive behavior in financial distress because I consider them somewhat less important. I've described them in the book. That's it for this video and for the dark side of debt. In the next video, we'll look at the bright side. See you soon. Bis bald.
As our CFO, what would you advise us to do now?
Easy. Heads, we declare dividend. Tails, we declare bankruptcy.